Welcome to Manager EDU. Today, I will teach you the price-cash flow ratio. I will define the ratio, explain its formula, give an example, and clear your concept about what the ratio and its value means. So, let's get started. The price-cash flow ratio compares the company's market price per share with its operating cash flow per share. This helps investors understand how much they are paying for each dollar of operating cash flow generated by the company. If the value of the price-cash flow ratio is higher, it is generally not a good sign for investors because it means they are paying more for each dollar of operating cash flow. If it is lower, it is considered a good sign, as it indicates the stock may be undervalued relative to the cash flow it produces. Now, let's learn its formula. Price-cash flow ratio equals market price per share divided by operating cash flow per share. In a cash flow statement, there are three sections: operating activities, investing activities, and financing activities. For this ratio, we focus only on operating activities. Operating activities are the activities that run the company's basic operations, the day-to-day business that generates cash. So, we take the net cash provided by operating activities from the cash flow statement, then we divide that amount by the total number of shares outstanding to get operating cash flow per share. Let's take an example to understand this. Suppose we have a company listed on the stock market. Now, let's say the company's market price per share is $60, operating cash flow per share $8. Now, we apply the price-cash flow ratio formula. Market price per share, $60, divided by operating cash flow per share, $8, equals 7.5. So, the price-cash flow ratio in this example is 7.5. Now, let's understand what this value means. A price-cash flow ratio of 7.5 means that an investor needs to invest $7.50 to get $1 of operating cash flow from the company. In other words, the market price is 7.5 times the operating cash flow per share. For a businessman or investor who wants to invest money in company ABC, this ratio helps them decide. If the price-cash flow ratio is higher, it means the investor has to invest more money to get the same amount of operating cash flow, which is not a good sign. If the ratio is lower, it means the investor can invest less money to get the same operating cash flow, which is a good sign. So, a lower price-cash flow ratio is generally more attractive to investors because it indicates better value for money. That was all about the price-cash flow ratio. If you didn't fully understand, you can watch this video again. Thanks for watching.